My name is Ryan Flanders, and I'm the Flanders Group's Chief Investment Officer. With the first half of 2022 in the rear view, and summer now in full swing, it's a great time to take a look at where we have been and where we may be headed to close out this year. As we enter the second half of the year, at first glance, the outlook may appear ominous. Inflation remains elevated near 40-year highs, while the Federal Reserve is tightening monetary policy to combat the rising prices. The war in Ukraine is ongoing, threatening to become a longer-term conflict. Midterm elections loom in the U.S., and now, over 2 years later, COVID-19 continues to spread both here and worldwide. Skimming through the headlines, it's natural to expect the economy to be in terrible shape. In contrast, though, the news is mostly upbeat when you look at the economic data. Job growth remains strong, and the labor market is still very tight. Consumers have not stopped shopping despite inflation and higher gas prices eroding their confidence, and businesses driven by that consumer demand and the labor shortage continue to hire as much as they can, and then to invest when they can. So despite the headlines, the economy remains not only healthy, but it's still strong. Unfortunately, as they tend to do in the short term, markets are reflecting the headlines more than the economy itself, and they're down considerably from the start of the year. However, while headlines can control markets in the short term, over the longer term, a growing economy generally will support the markets. And this relationship gives us hope that the recent stabilization will continue, and possibly that the markets might start to recover through the second half of this year. So the question is, with so many variables in play right now, how does the rest of the year play out? As always, the answer is, let's look towards the fundamentals and not towards the headlines. With so much momentum in place, the economy will keep growing through the rest of this year. Job growth has been strong and will stay that way given the high number of vacancies that we still have. And at the current job growth rate, we can keep growing at the same rate we are right now and still arrive at the end of 2022 with more open jobs than at any point pre-pandemic. This is one of the keys to the outlook for the rest of this year. When jobs grow, confidence and spending stay high. Confidence is down from its peak, but it's still well above levels of the mid-2010s, as well as those of 2007. With people employed and feeling good, consumers will keep the economy moving through the end of this year. To continue to service the customer demand, businesses will still need to continue to hire. And when they can't hire fast enough, businesses typically turn to investing in new equipment and processes, which will continue them on an upward path. And this is the second factor that will keep the expansion going through the rest of 2022. As we analyze the current state of the economy, there are two obvious areas of concern that we have: the tightening of monetary policy and the end of the federal stimulus programs. In terms of monetary policy, future damage is likely to be capped because most interest rate increases have already been fully priced into the markets. Here, the damage has, for the most part, already been done. And while federal spending has propelled us forward for the past couple of years, it now has run its course. And while this will slow growth some, much of the stimulus has now been replaced by income in the form of wages. So the damage should be limited as we continue moving forward. As we get the next GDP reading later this month, many eyes will be on net trade. Earlier this year, with exports up by much less than the imports, the economy shrank due to sharp pullback in trade. Just like some of the previous points, the good news is much of the negative impact has already happened. Data so far this quarter shows the terms of net trade have improved substantially, and that net trade should actually add to growth in the second quarter rather than detract from it like it did in Q1. So to recap, the foundations of our economy, consumers, and businesses are solid, and the weak areas are not as flawed as a glance at the headlines would suggest. Much of the damage may have already been done. Although we've seen some slowing is still growing, and this puts us on solid ground through the end of this year. So where are we headed? Well, let's circle back to the headlines. It was a turbulent start to the year, with the news affecting our expectations much more than the economy itself, which in turn clobbered the markets hard. Markets fell further as the Fed followed through on their word about raising interest rates. Entering the second half of the year, despite all these negative headlines and the interest rate increases, the economic fundamentals remain sound. Valuations are now lower and probably more appropriate than they were to start the year, and are showing signs of stabilizing. Even the headline risks, particularly regarding inflation and the war, are also showing signs of stabilizing. We are nearing the point of maximum perceived risk, and the downside risk for the second half is largely already incorporated. This means most of the damage is likely in our past. While that's not to say there is no risk, the existing risks are unlikely to keep markets in their downward spiral. Great news is not needed to see the second half of the year turn out better than it was in the first. We just need news that isn't quite as bad as it was when we started the year. While growth is slowing, as we said before, slowing is still growing, and the pace that the Fed continues to raise rates is likely going to be slower than current market expectations. And that combination should keep the economy and the markets on a positive trajectory to close out this year. While it may not be enough to dig us completely out of the hole from the first half, it should be much better than what we've seen to this point. We really appreciate you taking the time to watch today. If you're interested in continuing to hear more from us, please reach out to info@flanderscpa.com, and we will ensure that you are on our normal email list we send out with future market updates. Thank you.